Welcome, everyone. Ready to dive into The Intelligent Investor.
This book, seriously, it's like the Bible for anyone who's ever thought about investing.
Yeah, it's a classic, and for good reason. Warren Buffett himself says this book shaped how he thinks about investing.
I mean, we're talking about Benjamin Graham, right? The father of value investing.
No
So
doubt.
today we're going to break it down, all the wisdom, the key takeaways to help you guys become, well, more intelligent investors, right?
That's the goal.
Now, before we jump in, quick reminder. If you're hooked and want to explore more after this deep dive, you can find a link to the full book in the description or a pinned comment.
Always good to have that handy.
Definitely. Okay, let's get into it. One of the first things that really hit me was Graham's take on investment versus speculation. Seems obvious.
You'd think so.
But I think a lot of people get those two mixed up all the time. This is like fundamental stuff that unfortunately so many investors just miss. To Graham, investing is all about serious analysis, okay? You have to understand the business inside and out, not just chase a quick profit. It's got to offer two things: safety for your money.
Safety so you're not losing your shirt.
Right. And an adequate return. So it's not just about riding the wave of some hot stock tip.
Gotcha, so it's more strategic.
It's about treating stocks as ownership in actual companies, not just ticker symbols you see flashing on a screen.
Makes sense. Oh, and there's that analogy, right? The one about Mr. Market. It's brilliant.
Ah, yes, Mr. Market.
It's like a perfect way to explain how sometimes the market just doesn't make sense.
It really captures that irrational side of the stock market.
Refresh my memory. How does that work again?
Okay, picture this. The stock market is this guy, right? Let's call him Mr. Market. And every single day,
He's knocking on your door.
he's at your door, offering to buy or sell you stocks. Sometimes he's being reasonable. His prices make sense. They reflect the true value of the companies he's talking about.
Sounds fair.
But other times, he's totally off the mark. Prices all over the place, driven by fear, greed, who knows what else.
That's the stock market for you, right? Up, down, sideways.
Exactly. So the key here is this. Don't let his crazy mood swings control what you do. You got to use his irrationality to your advantage. When he's super excited and overpaying, maybe it's time to sell. But when he's down in the dumps, offering bargains, well,
That's when you swoop in.
you might consider buying.
That's a game changer. Really makes you think differently. It's like you're taking control, not letting the market push you around. This reminds me of another concept, the margin of safety.
Another key principle. It ties right back to Mr. Market.
How so?
Look, even if we do all the research, right, we analyze everything, we still can't predict the future perfectly.
Of course not. There's always something unexpected, some surprise.
Exactly. Things change.
Yeah.
And that's where the margin of safety comes in. It's basically a buffer, right? A discount built into the price you pay. It protects you from being wrong.
Like an insurance policy for your investment.
You got it. So even if your calculations are a little off,
You've got that cushion.
right, like a safety net,
Okay.
it minimizes the risk.
So you're not losing everything if things go south.
Exactly. And this brings us right back to focusing on the business itself, not just the stock price.
Because ultimately, you're buying a piece of that business, not just playing roulette with a ticker symbol.
You nailed it. You need to understand their finances, their competition, who's running the company, basically everything that contributes to its real value.
This is all making a lot of sense. So we've got the principles down. But Graham also gives some advice tailored to different types of investors, right?
He does. He talks about the defensive investor and the enterprising investor, recognizing that everyone's got different amounts of time, different personalities, different levels of risk they're comfortable with.
Right. Some people are more hands-on, others are more laid back.
Exactly.
So tell me about this defensive investor. Who are we talking about here?
This is someone who wants to invest smart, but doesn't want to spend all day, every day studying financial statements. They want a strategy that's simple, reliable, protects their money, and gives them decent returns over time.
Okay, I can relate to that. What's the game plan for them?
Graham's recommendation. It's classic. A diversified portfolio of stocks and bonds.
Stocks and bonds, the classic combo.
Yep. So how does this work? Well, he suggests starting with a 50-50 split.
Half and half. So stocks for growth potential and bonds for stability, for that steady income.
Exactly. But here's the most important part. Discipline. Be consistent. Graham's big on not freaking out when the market goes crazy. You stick to your plan, rebalance things every now and then to keep that balance you want.
So you're not jumping in and out, chasing returns, or panicking when things dip.
Right. You stay the course.
I like that. Steady and steady wins the race. What about specifics, though? Does he suggest particular stocks or bonds? Like certain industries?
For bonds, Graham likes high-quality fixed income stuff. Things like U.S. Treasury bonds, highly rated corporate bonds, maybe even municipal bonds if you're looking for tax advantages. The goal is to minimize the risk of anyone defaulting and to have a steady flow of income.
Sounds pretty solid. What about on the stock side?
He leans towards large, well-established companies, companies with a proven track record of making money.
What people call the blue chips.
Exactly. The big names, leaders in their industries, strong financials, consistent dividends, companies that have been around for a while. And this is where diversification is key, right?
Don't put all your eggs in one basket.
Exactly. Spread the risk. If one company has a bad year, it won't tank your whole portfolio.
Makes a lot of sense. So, given all this, would you say index funds are a good option for the defensive investor?
You know, later in his life, Graham actually came to appreciate index funds.
I can see why. It's a simple way to get exposure to the market without the hassle of picking individual stocks, and it's low cost. And it takes the emotions out of it.
Exactly. Aligns perfectly with Graham's whole philosophy. Minimize risk, aim for those steady, long-term returns.
Now, you mentioned another type of investor, the enterprising investor.
Right.
Who are they? And how are their strategies different?
That's a great question, and one I think we should save for after a short break.
All right, so we were in the middle of talking about this enterprising investor.
Right, the one who's ready to dig a little deeper.
Exactly. So remind me, what sets them apart from the defensive investor?
The enterprising investor, this is someone who's not afraid to put in the time, do the research, maybe take on a bit more risk to try and beat the market.
So they're more active, more hands-on.
Yeah, they're not just buying and holding. They enjoy the challenge, finding those undervalued companies, and they're hoping for bigger returns.
Okay, makes sense. What kind of strategies are we talking about here? What does Graham recommend for them?
Well, remember net investing. We touched on that earlier. That's a core strategy for the enterprising investor.
Right, buying companies for less than their net current asset value.
Exactly. It's like, finding a dollar bill for 50 cents.
It's like a pretty sweet deal.
It is, but it's not as easy as it sounds. You can't just look for low stock prices and call it a day.
So walk me through it. What are the steps? How do you actually find these net opportunities?
First things first, you got to dive into those financial statements. Balance sheets, income statements, the whole shebang.
Okay, I'm feeling a little intimidated already. But I'm with you. Remind me, why is the balance sheet so important here?
Because that's where you find all the good stuff. The assets, the liabilities, that's what you need to figure out the net current asset value. It's like you're trying to determine what would this company be worth if they sold everything off today.
So you add up all their assets, cash, inventory, all that, then subtract their liabilities, right?
Right. And that number you get, you compare it to the company's market cap, which is basically the total value of all their shares. If the market cap is way lower than that net asset value, that's when your ears should perk up.
Uh-huh. That's the net opportunity.
You got it. But here's the thing. It's not just plugging numbers into a formula. You have to really understand what those numbers mean.
Right. Some assets are worth more than others.
Exactly. That's where the real analysis comes in. You might have to adjust the value of certain assets, like inventory, and some liabilities are more pressing than others.
So you need to look beyond the surface. It's more than just basic math. You're making judgments about the quality of those assets, how urgent those liabilities are.
Exactly. It takes a good understanding of accounting and a bit of a detective's eye.
Okay. I'm starting to see why this is more enterprising investor territory. So let's say we found a potential net company. What else should we be looking at?
Good question. Because a low price doesn't always mean a good investment. Graham was big on looking at the whole picture. What's their track record? How much debt do they have? Who's running the company?
So even with a seemingly good deal, there could be red flags.
Always. Maybe they're drowning in debt or facing a ton of competition or the whole industry is shrinking. You have to ask, why is the market undervaluing this company?
Right. Is it a temporary blip or something more fundamental?
Exactly. And never forget Graham's margin of safety.
Right, that buffer. How does that work with net investing?
Well, you're already buying at a discount to the company's estimated value, but you can take it further. Be conservative with your estimates, maybe haircut some of those assets by 10% or 20% just to be safe.
So even if you're a little off with your calculations, you're still getting a good deal.
Exactly. It's like an extra layer of protection.
I like that. A safety net for your safety net.
You got it.
This is all super interesting, but I have to wonder, are these net opportunities even out there anymore? It seems like everyone's looking for them these days.
You're right. They're not as common as they used to be. Information travels fast these days. It's harder for companies to stay under the radar. But that doesn't mean they've disappeared entirely.
So where should someone even start looking?
Well, Graham had some ideas about that too. He had specific areas he liked to focus on, and that's a perfect place to pick up after a quick break.
All right, so we're on this treasure hunt for net companies, following Graham's footsteps. But where do we actually start digging?
Well, Graham had some favorite spots, you know. He wasn't just randomly searching. He focused on areas where things were more likely to be mispriced.
Give me an example. Where should we be looking?
One of his go-tos, smaller companies. You know, the ones that often get overlooked by the big players in the market.
Interesting. Why smaller companies?
Okay.
Wouldn't bigger companies be, I don't know, easier to analyze, maybe less risky?
You'd think so, right? But Graham actually believed smaller companies had more potential for net investing. They don't get as much attention from analysts, so their true value might be hidden.
So fewer people looking means a better chance of finding those bargains.
Exactly, like finding a rare shell on a quiet beach. Not everyone's combing through it.
Okay, I'm following you. Smaller companies, less coverage, more chances for those hidden gems. What else? Where else did Graham like to look?
Another spot. Companies that were going through tough times, maybe restructuring.
Hold on. That sounds a little counterintuitive. Why would a company in trouble be a good opportunity?
Well, think about it. When things are rough, fear takes over, right? Investors panic. And sometimes they overreact, pushing the stock price down way more than it should be.
So you're saying buy low, sell high, that whole thing?
It's more than that. It's about recognizing when the market is being irrational. Graham was brilliant at that. He knew that during those times, you're more likely to find companies trading below their real worth, even if they have a chance to bounce back in the long run.
So it's about being brave enough to go against the crowd, but also smart enough to see if the company can actually recover.
Exactly. Of course, it's riskier. You have to be extra careful with your analysis, make sure they have a solid plan to turn things around.
Right. Okay, so smaller companies, struggling companies. Any other areas Graham recommended?
Spin-offs. Keep an eye on those.
Spin-offs. Remind me what those are again.
It's when a big company splits off part of its business, creates a whole new company that's traded separately.
Okay, and why would that be a good opportunity?
Well, sometimes investors in the original company aren't interested in that new spun-off business. They might just sell it off without really looking at its value.
So it's like a hidden treasure that everyone's ignoring because they're focused on the main event.
Exactly. And Graham, he had a knack for spotting those situations, finding the value that others missed.
This is all making a lot of sense. I'm starting to see how this enterprising investor approach can really work, but it definitely takes work.
It does. It's not passive. But for those willing to put in the effort, the rewards can be significant.
And even then, Graham still believed in diversification, right? Keeping some of your portfolio in bonds for that stability.
Absolutely. No matter what kind of investor you are, managing risk is crucial.
So for all those listeners out there who are thinking about taking the enterprising investor path, what's one piece of advice from Graham that you think they should really keep in mind?
This one always sticks with me. The investor's chief problem, and even his worst enemy, is likely to be himself.
Wow, that's pretty deep. What did he mean by that?
He understood that our emotions can really mess things up when it comes to investing. Fear, greed, impatience, they lead to bad decisions.
So it's about being in control of your emotions, not letting them control you.
Right, and that's where that whole idea of Mr. Market is so helpful. Remember, he's always there tempting you, trying to get you to react, but you get to decide. You decide when to buy, when to sell.
It's about having a plan, being disciplined, and sticking to it. Not getting swept up in the hype or panicking when things get rough.
Exactly. And if you really want to dig into this stuff, learn all the ins and outs, remember there's a link to the full book in the description or pinned comment.
Always a good reminder. That book really is a treasure trove of information for anyone who wants to become a more intelligent investor.
Absolutely. And with that, I think we've reached the end of our deep dive into the intelligent investor. We've covered a lot, from the basics of value investing to strategies for different types of investors.
Hopefully you all feel a little bit smarter about investing now. Understanding Graham's ideas, it can really help you navigate the market and build wealth over time.
Remember, investing is a journey. Keep learning, keep growing, and most importantly, keep investing intelligently.
Couldn't have said it better myself. Until next time, everyone, happy investing.